What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Billionaire and legendary investor Paul Tudor Jones was recently featured on CNBC. He was being questioned about what to expect from the Federal Reserve as they meet this week for their FOMC meeting, and how to invest in preparation for what they might say. And so today we're going to dive into the advice that billionaire investor Paul Tudor Jones gave and why he gave it. Ready? Let's dive in. Paul Tudor Jones is arguably one of the best investors in the world, with one of the best track records as well. In regards to the upcoming Fed meeting this week, he said that this is arguably the biggest Fed meeting in 4 or 5 years, and one of the main reasons is simply because we've had some of the biggest jumps in inflation in May and in April that we've seen in a long time. In fact, last month, we had the largest jump in core CPI that we've seen in 29 years since June of 1992. Now, we know that the Federal Reserve has been pushing for higher inflation so that they can say, hey, we've averaged 2% because our mandate by Congress is stable prices, even though technically rising prices is not stable prices, which I will never let go of that. But they're saying, hey, we need to hit 2%. That's a good way to achieve price stability over time. Now, their other mandate given to them by Congress is full employment, and it looks like that is the one that they're really leaning in on and really driving home, almost to the point of just ignoring whatever happens with inflation as long as they're moving closer to their goal of full employment. And so Paul Tudor Jones, he said, basically the Federal Reserve has two options. We're likely to see one of two options from the Fed this week. Option number one is they'll say, hey, full steam ahead. And that would be them saying, hey, we're on track. Everything is looking good. We're achieving numbers that we've been hoping to see. Anything that might be concerning to the market, like, the highest inflation jump in 29 years, that's transitory. That's going to go away. That's due to supply chain issues. We're not worried about that. We're not concerned about that. We're not going to taper. We're not going to raise interest rates, nothing like that. We will let you know down the road if we're talking about that, but we're not talking about that right now. So if they just say business as usual, full steam ahead, that's option number one. The second option is that the Federal Reserve comes out this week and says, hey, we're slowing down now. We're talking about raising rates. We're talking about winding down our asset purchases. Right now, they're still buying at least $120 billion per month in mortgage-backed securities and treasuries. And so they might come out and say, hey, we're going to wind that down to maybe instead of at least $120 billion, that'll be a max of $120 billion. They just recently announced that in keeping with their prior timelines that they were going to start selling shares of the high-yield bond ETFs that they own in the special purpose vehicles held at the Treasury, which again, that's another thing they're not legally allowed to own. And so they just created separate accounts that are held by the Treasury and they just give them the money for it since they are not allowed to own those on their own balance sheet. Nice little legal loophole there. So essentially, those are the two options. Those are the two potential things that the Federal Reserve might say. Number one, full steam ahead, or number two, we're going to slow down. Now, the third thing that's not really an option is completely reversing course and actually starting to taper right now, selling assets off their balance sheet instead of just slowing down their purchases and raising interest rates this week. These are things that, in my opinion, are so unlikely they're basically not even worth discussing, because the Federal Reserve over and over and over again for like a year and a half or 2 years now has basically said, we'll let you know in advance of when we're going to start talking about doing these things. They want to give the market plenty of time to prepare. And so there's really only those two options: full steam ahead or talk about slowing. So what is Paul Tudor Jones? What is his investing advice if they just say full steam ahead? Well, he said basically go all in on inflation hedges, or at least that's what he would do. If they're going to continue their asset purchases, continue to keep rates as low as they are, continue to push for more fiscal policy, more fiscal spending, which monetary is anything done by the central bank or the Federal Reserve in this case. Fiscal policy is anything done by Congress or the government. So that would be like spending and stimulus bills and things like that. And so if the Federal Reserve comes out and Powell starts talking about, hey, we're going to, full steam ahead, all in on inflation hedges, says Paul Tudor Jones. That's Bitcoin, that's gold, silver, commodities. They're just going to continue to expand the money supply. He said inflation is not something that is transitory in his economic outlook. Inflation is something that has long-lasting impacts. You can't just flip on a switch and turn it off at will. And his reasoning behind why they might do this is simply because, like I mentioned earlier, they're basically prioritizing full employment over anything that happens with inflation. This is one of the reasons why they've been so outspoken about how much they believe believe this inflation is transitory, and before that, why they were so outspoken about wanting to see higher inflation numbers, because they knew it was going to have to happen if they were going to expand the money supply by this much. And so if they go full steam ahead, it'll look like they're just saying, hey, we don't care what else happens as long as we're reaching the goal of maximum employment. Now, as a side note, this is kind of difficult to do when you have fiscal policy, which monetary policy funds fiscal policy basically. When you have a government who's spending money in excess of what they make from taxes or borrowing, the shortfall basically has to be covered by money printing from the central bank. And so if the central bank's mandate is full employment, but the central government, fiscal policy is geared towards something that is incentivizing unemployment, that's actually very counterproductive, as you might be able to tell. When you give people money and say, hey, I'm going to pay you to not work, and then you have the person or the entity who's creating that money saying they're creating it in order to put people back to work, you've got counterproductive goals going on. And so it's yet to be seen how the Federal Reserve intends to use their monetary expansion to meaningfully move towards full employment. All right, so what's the next option? Well, the next option is slow down, right? I already said they're not going to reverse course, but they might say they're going to start slowing down. And Paul Tudor Jones said that basically what will happen if they give any sort of indication that they're going to start slowing down here, you're going to see taper tantrum take place. Now, what do you think would happen to the price of Amazon stock if Bezos announced that every single month he was going to start selling a ton of his Amazon stock? What do you think would happen to Tesla if Musk announced that he was going to start selling a ton of his stock? When the biggest player in a market reverses course, changes their actions, it changes the market. And the Federal Reserve is the biggest player in the bond market. And so if they announce that they're going to be changing their actions, if they're going to start purchasing less of them, which means that in the future they might start selling them, it's going to prompt changes in the rest of the market. You'll have any institution that can start to sell their bonds and their treasuries in anticipation that the biggest player at some point in the future will start to sell. And even without that front running taking place, the reason bond prices are at the prices they're at right now is because that's the equilibrium point in between all of the buyers who would be driving the price up and all the sellers who would be driving the price down. That is the market price of anything. It is the equilibrium. It is the aggregate consensus of all the potential buyers and sellers. And so if one of the biggest players in that market reduces the amount that they're purchasing, that alone gives the sellers more power and will drive the prices down just by that alone, regardless of any front running or any other market participants' action. And I say front running, it's not really front running, it's just discounting future expectations. That's how markets work. If you own something, let's say an iPhone, I love using the used iPhone example. If you've been around the channel, you know I'm always talking about selling used iPhones on eBay. But if you're the only one who knows that at the end of this year, there's going to be a new iPhone coming out, you've got an iPhone right now, you could sell it for, let's say, $500, and you know that if you wait 1 month, it'll only be worth $400. Well, you're going to sell it now in anticipation of taking advantage of that extra $100. But everybody knows that this is what happens. So as you approach the date of the new iPhones coming out, you'll notice old used iPhones on eBay, they start dropping in price because more and more sellers come in anticipation of that. You're basically just pulling expectations of the future. What's guaranteed in the future starts to get priced into the present. As something becomes more and more certain in the future, it comes into the present price because the market is acknowledging that that is going to be happening. If the market knows for certain something's going to be true tomorrow, it becomes true today. Along with a sell-off in bonds, that would also spark a severe sell-off in equities, because a sell-off in bonds means higher interest rates, and corporate America cannot afford higher interest rates right now because corporate America is so over leveraged that any rolling over of that debt into new debt that is higher interest rate, you get tons of insolvent companies, you get tons of bankruptcies, tons of defaults. So corporate America cannot survive a spike in interest rates. And so you would almost immediately see a drastic drop in equity prices if you also see a drastic drop in bonds. So finally, what do I think? What do I think the Fed will say, and how am I playing this? And keep in mind, this is not investment advice. I'm just a guy on YouTube. In my opinion, I think the Fed was most likely to just start giving lip service to being more likely to start talking about tapering in the future. Their actions will still be full steam ahead, but their words will indicate that they're slowly starting to watch more and more things that would indicate they're going to start talking more and more about when they might start tapering in the future. So lip service to slowing down, but in action, prediction, they will be full steam ahead. And I would not be surprised at all to see this spark a quick sell-off in bonds and equities, followed by a very quick recovery and then new all-time highs, big rally after that, as the market realizes that actions by the Fed are still full steam ahead, and then any talk towards slowing down or tapering in the future has a very little possibility of ever actually taking place. But I could be wrong, so how am I playing this? Well, first off, I don't change my positions in gold, silver, or Bitcoin based on short-term expectations. I'm not trading around in those positions. And even Paul Tudor Jones said, I just know that I want 5% in gold, 5% in Bitcoin, 5% in cash, and 5% in commodities. Now, obviously, there are plenty of people who do trade around in these positions because some of them, like Bitcoin, are very volatile. But in my opinion, it's just not worth the risk that you miss out on a quick, in 10 minutes moves up 10%. You miss out on some of those gains just for the potential that you might be able to buy in at a lower price or vice versa. These are long-term core holdings that give your portfolio a lot more stability, a lot more inflation protection, uncorrelated movements. And so to me, the risk of even temporarily being under or over allocated to any of these is just not worth the small reward that might happen because of it. With equities, I'm essentially straddled right now. Commodities, I'm long. The dollar, I'm short, and bonds, treasuries, I'm flat right now, although I'm highly considering throwing a short on before the meeting. And if you don't know how to hedge, how to straddle, how to place limited risk speculative bets on movements, that's why I built my options courses. I've got a beginner's options course and an advanced one. I've got them both linked in the description below. So in summary, the market is waiting in expectation to see what comes out of the Federal Reserve's meeting this week. It's all just one big trade now. Everything trades off of the words and actions of the Fed. If they indicate full steam ahead, a good play is likely to be all in on inflation hedges, as Paul Tudor Jones said. If they indicate that they are going to start tapering or slowing down, we're likely to have a taper tantrum and a sharp sell-off in both bonds and equities. If you enjoyed this video and it was helpful at all to you, it would mean the world to me if you hit that subscribe button, because I have a completely arbitrary and personal and meaningless goal of hitting 50,000 subscribers on this channel by the end of this month, June. So if you're not subscribed already, it would mean the world to me if you help me out with hitting that goal. And as always, thank you so much for watching. I really appreciate you guys. Have a great day.